Welcome to Course 08 of the MaxLife Commercial Academy, Investment Analysis and Risk. I'm Ryan Solberg, real estate broker with MaxLife Commercial here in Central Florida, license number 33541. In this course, we're going to cover the tools and frameworks professional investors use stress test deals before they ever write a check. You'll learn how to run sensitivity analysis, calculate debt yield, build a 3-scenario pro forma, and, just as importantly, how to recognize when a deal is too fragile to touch. Whether you're evaluating your first commercial property or your 50th, these skills will make you a sharper, more disciplined investor. Let's get into it. Before you can analyze risk, you need a clear taxonomy of what you're actually measuring. Commercial real estate deals carry at least 6 distinct categories of risk, and professional investors evaluate all of them before underwriting. Market risk is external. It's about what's happening to vacancy rates, rent growth, and new supply in your specific submarket. A property can look great on paper until you realize 3 new competing buildings are delivering in 18 months. Credit risk is about the tenant, their financial strength, their lease term, and whether they have personal or corporate guarantees backing the rent. A 7 cap with a strong investment grade tenant is a fundamentally different investment than a 7 cap with a local restaurant on a month-to-month. Liquidity risk is about your exit. Commercial real estate is illiquid by nature. Smaller assets in secondary markets can take 6 to 18 months to sell, and in a downturn, that window extends further. Leverage risk is about your debt. When you finance a deal, you're amplifying your returns in both directions. A 10% drop in value on an unlevered deal costs you 10%. On a 70% LTV deal, the same price drop could wipe out a third of your equity. The remaining 2 types, operational risk, which includes management, capex, and lease-up execution, and regulatory or environmental risk, including zoning changes, entitlement delays, and Phase 1 findings, round out the picture. A disciplined investor maps all 6 before touching the spreadsheet. Sensitivity analysis and scenario analysis sound like the same thing, but they serve different purposes and you need both. Sensitivity analysis isolates a single variable and asks, if this one input is wrong, how much does it hurt me? You might build a grid where your rows are exit cap rates, say 5.5, 6.0, 6.5, 7.0. And your columns are year 5 NOI assumptions ranging from flat to plus 15%. Each cell shows your IRR or equity multiple under that combination. This tells you exactly where your break even is and how much cushion you have. Scenario analysis takes a broader view. Instead of moving one variable, you assemble a full, coherent story. In a recession scenario, maybe market vacancy jumps 400 basis points, rent falls 10%, and your exit cap rate expands 75 basis points, all at the same time. That's a downside scenario. Your upside scenario might assume rent growth tracks inflation, you lease up a vacancy in year 1, and you exit at a compressed cap. Your base case sits in between. The critical output from scenario analysis is whether your downside NOI still covers your debt service. If a realistic bad case puts you below break even on the loan, that deal has a structural flaw that no amount of optimism can fix. You're not trying to prove the deal works, you're trying to prove it doesn't break. When a lender underwrites your deal, they're running their own risk analysis, and the 2 metrics they care most about are debt yield and break-even occupancy. Debt yield is simply your net operating income divided by the total loan amount. If a property generates $300,000 in NOI and you're borrowing $3.5 million, your debt yield is 8.6%. Most institutional lenders today want to see debt yield above 8 to 10%. Unlike LTV, debt yield doesn't depend on an appraisal. It's a pure income test. A low debt yield tells the lender that the loan is heavily underwritten relative to the income the property actually produces. Break-even occupancy tells you how low occupancy can drop before the property stops covering expenses and debt service. You calculate it by adding total operating expenses to annual debt service, then dividing by gross potential rent. If that number is 82% and your submarket runs at percent occupancy, you have 6 points of cushion. That might be enough. But if your break even is 91% in that same market, one bad year of leasing could put you in a cash flow deficit. DSCR is related. It's the ratio of NOI to debt service. A 1.25x DSCR means your income is 25% above what's needed to make the loan payment. The tighter that ratio, the less room for error. Run all three on every deal before you negotiate the purchase price, because these numbers tell you what the lender will say before you ever sit down at a bank. A 3-scenario pro forma is the standard deliverable in institutional commercial real estate, and it should be your standard too, regardless of deal size. The idea is simple. You can't predict the future, but you can build 3 coherent versions of it and understand what each one means for your investment. Your base case should be built on reality, not on the seller's pro forma. Use trailing 12-month actuals for income and actual expense statements. Apply market vacancy, not 0%, and use conservative rent growth in the 1 to 2% range annually. Your base case is what happens if everything goes roughly as expected. The upside case models a favorable environment. Maybe you lease up a vacant suite faster than anticipated, rents in the submarket grow above inflation, and you exit into a compressed cap rate environment. Model it, but don't underwrite to it. Your hurdle rate needs to be cleared in the base case, not just the upside. The downside case is where real discipline lives. Combine higher than market vacancy, think 200 to 400 basis points above the submarket average, with flat or declining rent, unexpected capital expenditures, and an exit cap rate that's expanded by at least 50 to 75 basis points. That's a realistic bad year, not a catastrophe scenario. If your downside case produces a negative IRR or puts you below debt service coverage, one of two things needs to change. The price comes down, or the leverage comes down. A deal that only works in the base and upside scenarios is a fragile deal. Running scenarios is one thing. Stress testing is more specific. It's about identifying the single biggest vulnerability in a deal and then modeling exactly what happens if that vulnerability materializes. For most commercial deals, the biggest risk lives in the lease. If you're buying a single tenant retail property with a lease that expires in 4 years, you need to model exactly what happens if that tenant doesn't renew. What are re-leasing costs in your market? How long does the space sit vacant? 6 months, 12, 18. What rent can you achieve from a replacement tenant? Run that through your pro forma and see what your IRR looks like with an 18-month vacancy in year 4. That's the lease stress test. For floating rate debt or any deal with a rate reset, model what happens if rates increase 200 to 300 basis points before your next fix or refi. In 2022 and 2023, a lot of deals that penciled in 2021 became deeply distressed because operators hadn't stress tested the interest rate assumption. Downside protection comes in the form of deal structure, longer fixed rate debt, interest rate caps, tenant improvement allowance, reserves, and adequate equity at close. The goal isn't to avoid all risk. The goal is to understand exactly which risk you're accepting and to have a plan for surviving the bad version. If you can't articulate your downside protection strategy, you don't understand the deal well enough to close it. Two deals can both show a projected 14% IRR and be completely different investments from a risk perspective. Raw return metrics, IRR, equity multiple, cash on cash yield, tell you the expected outcome if your assumptions are correct. They say nothing about the range of outcomes or the likelihood that your assumptions are wrong. Risk-adjusted return thinking asks a different question. Given the full distribution of possible outcomes, which deal gives me the best return per unit of risk I'm accepting? The simplest way to operationalize this is probability-weighted returns. Assign probabilities to your three scenarios, maybe 60% base, 20% upside, 20% downside. Multiply each scenario's IRR by its probability and sum the results. That's your expected IRR, adjusted for the realistic range of outcomes. Now compare two deals. Deal A has a base IRR of 14%, an upside of 19%, and a downside of positive 4%. Deal B has a base IRR of 16%, an upside of 22%, and a downside of negative 18%. Deal A's probability, weighted IRR, might be around 13.4%. Deal B's comes out to about 13.6%. For 20 basis points of expected additional return, Deal B asks you to accept a scenario where you lose nearly a fifth of your investment. That's not a better deal. It's a riskier deal with a slightly higher average. Risk-adjusted thinking reveals that asymmetry. Professional investors and institutional equity sources think this way on every deal. If you want to compete for capital or simply protect your own, you need to think this way too. One of the most valuable skills in commercial real estate is knowing when to stop. Not every deal should close, and the discipline to walk away from a fragile deal is what separates experienced investors from those who chase yield into trouble. There are a handful of red flags that should give you serious pause, regardless of how attractive the headline numbers look. First, if the seller's pro forma is built on rents that are materially above market, you're being sold a story rather than a property. Underwrite to market rents and see what you actually own. Second, if your break-even occupancy analysis shows no cushion against the current submarket vacancy rate, a single tenant loss breaks the deal. You're buying a property with no room for error. Third, and this is the most important test, if your downside scenario produces a negative IRR or drops your DSCR below 1 point, stop. That means a realistic bad year wipes out equity or puts you in default. A deal that can't survive its downside scenario isn't an investment, it's a bet. Other red flags include deferred capital expenditures the seller won't credit, environmental issues requiring further investigation, and restricted due diligence access. That last one is especially telling. A seller who won't provide trailing actuals or limits your access to the property is telling you something without saying it directly. Walking from a deal doesn't mean you lost. It means you understood the risk clearly enough to make a disciplined decision. The best investors I've worked with, and here at MaxLife Commercial we see a lot of deals across Central Florida, will tell you that their best decisions were often the deals they didn't do. That wraps up Course 08, Investment Analysis and Risk. You now have a professional framework for stress testing commercial real estate deals, identifying the 6 types of risk, running sensitivity and scenario analysis, calculating the lender metrics that determine whether your deal gets financed, building a 3-scenario pro forma, and recognizing when a deal is too fragile to close. These tools don't guarantee a good outcome. Nothing does in real estate, but they will ensure that when you close a deal, you've done so with eyes wide open. I'm Ryan Solberg, real estate broker with MaxLife Commercial, license number 335431. If you have questions about a deal you're analyzing in Central Florida or anywhere across the state, give us a call at 321-586-2121 or visit us at maxlifedevelopment.com/academy to continue your education. The next course is Finding Commercial Deals. We'll cover how to source off-market opportunities, work with brokers, and build a consistent deal pipeline. We'll see you there.